And good afternoon, and welcome back to Discuss with Russ. I'm Russ, founder and president of Voice Wealth Management. This is episode 11 of Discuss with Russ, and my guest this afternoon is Ross Karp of 3P Insurance. Our topic this afternoon is Family Matters, how to navigate the new life insurance market. For those of you tuning in today for the first time, the Discuss with Russ series has focused on helping you get through the COVID crisis and start thinking and planning for what the world might look like as the crisis dissipates. Now that we can leave our homes and start to see each other face to face again, we want to help you anticipate further possible responses in society's behavior so you can be most prepared to succeed. Voice Wealth Management firm primarily works with entrepreneurs, young professionals, and their families to help them get the most out of their money. I am a chartered financial analyst and certified financial planner. Many also see me as their personal CFO and financial therapist, recognizing the psychological power of money in addition to using short-term and long-term planning to help you get the most out of every dollar you earn and use. Now on to our guest, Ross Karp. Ross is a licensed life, disability, and long-term care insurance broker, starting in the industry in 2005. Focused on more than policies and procedures, he believes in the human aspect of the industry, help protect people, their wealth, their families, and their lifestyles. He started 3P Insurance Services in 2011, but before entering the insurance industry, Ross was a high school history, psychology, economics teacher. It is because of his extensive classroom training that Ross knows how to make complicated concepts easy to understand. And with my background and his background, you get some radio guy today, as Ross was also a professional DJ for 10 years. So with that, Ross, welcome to the program. How are you today?
Great. Thanks for having me, Russ. Greatly appreciated.
We talked about what I guess makes us exciting, but we're going to launch into insurance, which, a lot of people can think is a pretty staid, boring topic. But anyway, let me ask this, because we always try to start the program by talking about how things were before we entered the crisis. So before the pandemic really hit hard, were there any trends in the insurance business that were of particular interest to the audience and customers and the like?
I think as far as trends go insurance-wise, I think I'm going to focus more on the clients. It's, hindsight is 2020, and 2020 has provided us a lot of hindsight. Coming into this, clients would put things off. We would get up, we'd go to work, we'd work our multi-hour days, come home, have dinner, go to sleep, and start the rat race all over again. And so people would put off planning. There was a lot of, well, it's not going to happen to me, and you just keep running and running. And then all of a sudden, COVID hit. And now we're staying at home, we're spending more time with our families. So now we're thinking about that planning a little bit more. So I think we went from avoiding the planning to now thinking about, we need to plan. What if something happens? It's no longer, well, the if's not going to happen to me, it's going to be the other guy. So because we're spending so much time with our families, we really started to think about it more. And that's what we're seeing. People wanting to have that conversation, more open to it. The other part of the equation is people are really understanding how much their homes is their comfort space, and how if something happens and as they get older, if they need care, they're realizing, hey, they want that care to take place at home. What provisions are they making to prepare for that? So again, that's leading them to be more open to those, conversations about planning.
Fair enough. So if we think about the pandemic itself and kind of how it's affected the industry and people who had policies and stuff that was in force, did you see companies starting to do anything unique as a result of this? For example, I know you hear from all these auto insurance companies online saying, "Oh, we're dropping premiums," and all of that. Same thing happening on the life side, or at least some sort of other things relating to those things now that we're in this unique situation?
Not that I've seen on the life insurance side. I think we've seen more of carriers, giving people a break to the extent of if you miss your premium payment and it's COVID related and there's a hardship that's COVID created, they're giving like a 90-day extension. And listen, we're coming up, onto that 90-day, mentality for some of them. So they may start to extend it even more. And again, they'll probably take the government's lead. If the government says, hey, you need to do this, they'll do it. Now, with that said, you push out your premium payment in 90 days, carrier's going to say, okay, once we come out of this, you're past that 90 days, you now have to come up with a plan to pay back your back premiums. And they're giving people a year to, pay it out over time.
So, yeah, and I know a lot of that 90-day forbearance came because of an executive order, at least in New York, from Governor Cuomo. So, do you know in terms of how people, how many people are taking advantage of those forbearances, or, they actually affect in-force policies if somebody needs to use them? It sounds that they pay back premiums. Is that part of what's going on here?
Well, in all honesty, I think my clients have been very lucky because I have only received one call from somebody who wanted to take advantage of the forbearance. So I don't really have an overall number of how many people are actually doing it. I know from the clients that I've seen, there hasn't been much demand and ask for it, but I'm sure there's tons of people who have needed it and wanted it. You just look at the unemployment numbers that are out there, and you look at the numbers and the rates, people are going to need it. Luckily, again, I haven't had two things my clients are lucky for. A, they haven't needed to ask for it. B, none of them have passed because of it. So I'm a good luck charm, I guess.
So what else did insurance companies do as a result? So for example, back in March, I was in the midst of writing a policy for someone, and then they needed a medical exam. So they've basically been on hold because they haven't been able to get the exam done. But I've also heard that companies are in this time kind of loosening the standards of having a paramed or having someone visit your home to do some sort of medical exam. So what's going on with that?
So a lot of the carriers did what we call accelerated underwriting, where if you had copies of your doctor's records and if you'd been to your doctor recently, they would accept the blood work from your doctors and review it. Again, sometimes the problem there is getting records from the doctors. So, they've created portals for clients if they had it and were able to obtain it through their doctor portal. The carriers created a portal for them to transfer those records to them. Other carriers would reach out to the doctors and try to get them. I know that's been kind of the thing that slows things down the most, is getting those records. But part of the accelerated program was, some quick questions. And the carrier might say, look, if you meet these qualifications, we can give you, $1 million of insurance. Some have gone up to 2 and some have gone up to 3. It just depends on the carrier and the conditions. And some of the things that, they're asking, people who are non-smokers, people who are between certain ages, again, benefit limits. And then there were other questions, of concerns that they would have, such as, did a person, declare bankruptcy in the last 5 years? Have they used marijuana in the last 5 years? DUIs, felonies, where do you fit on the height weight chart? And then obviously they ask about major medical conditions, things that they would probably during the regular underwriting process find out about, but for the accelerated part, if there's not a problem, they're going to move forward with it. If there is a problem, they're going to want to see more records.
So I was thinking about something else. I mean, one of the things I know I've had to deal with, especially with people renewing policies or doing replacement policies, that a lot of carriers are still requiring paper applications. Some of those that have been requiring that been allowing things to go electronic? If so, how?
So one of the things that they're accepting, and they are trying to get better technologically, they're still far behind, but they are taking applications, they are taking, e-doc signatures, but when it comes to delivering the policy, they're going to want, what they call the wet signature, and see that. Now, obviously the client sends it to us. We don't necessarily have to send the hard copy of the wet signature, but we can we could scan it and send it to the carrier, but they're trying to make things a little bit easier. I think there's a long way to go on the technology side of what they can accept and what compliance and states will allow them to do. It's just it's a slow process, unfortunately, and they were kind of thrown into this trying to play catch up as well.
Sure, understood. And I know the courts have been trying to do the same thing, trying to figure out how to do things on a more expedited and virtual basis. I know while my industry, in terms of the investment industry, has been moving towards electronic and doing some of that a little bit faster, the insurance business has. I realize that's a problem with some people, for some people. So with over 100,000 Americans having died as a result of COVID, you obviously mentioned that your clients you haven't had any clients die and all of that, but has your business changed? Have you been saying, oh, I better write policy now because, again, now I've got a plan, now I've got time to think about this? Or, has there, what are the other trends that you're seeing in terms of how your business has changed over the last 3 months?
So as far as how my business has changed, it's been a very interesting dynamic. When COVID first started, we had people who were going to work who are now working from home. Well, not everybody has a home office or the infrastructure in place. So for the first couple of weeks, people were trying to get themselves set up to work from home, and themselves, their spouse, and then if you have children, you're trying to get your children set up to be educated from home. So not only are you trying to do your job, but you're also trying to educate your children and make sure that they're doing what they have to do and make sure that they're set up. So the first couple of weeks, it was a little chaotic for people on that front. Then the stock market decided to not cooperate and decided to go down dramatically and act a little sporadic. And a lot of our clients come from folks like yourself, who, they're wealth advisors, and, they farm the insurance portion out to us and partner with us and do it. So they weren't having the full planning conversations with clients. They were talking to them about their investments. How were they allocated? How were they insulated from all of this? If they were in cash, when did they get in? Let's time the bottom. Should we go into cash so that we can time? So there was all these conversations, but there weren't a lot of conversations about the life insurance and the full planning being done. Now, fast forward 13 weeks later, obviously people are getting used to this new norm. What they hope is not going to be a full new norm, but we know it is for the short term. And we are starting to now see conversations perk up a little bit.
I'm surprised because, again, I guess specifically around some, life insurance for sure, maybe somewhat for long-term care, you have, all of this morbidity, right? So much talk about nursing home. All of the, these things being top of mind, being top of news every day. What would stop somebody from saying, oh, wait a minute, am I where I want to be? Do I need to do something?
And again, I think in the first part of this, there was so much chaos going on. People needed to get settled in. It's really from the second part on where we've seen, the uptick in clients coming to the table and wanting to have those conversations.
Fair enough. So what are some unique strategies that you're seeing people come up with and use to protect themselves and their families instead of or in addition to what they might have already had in place? So and are goals changing as a result of the time?
I don't think there's necessarily been a change from what we've seen on that front as far as the types of planning that's being done. When we're sitting with clients, our plan hasn't changed. It's been, if something happens, where are the gaps in your cash flow? Where's your gaps in your expenses? And how can we protect that? And then you look at the levels where it's needed. Is it short term? Is it moderate? Is it long term? And then staggering the types of policies we put in place based on that. So you could use shorter terms and then maybe have a term go out a little bit longer for a portion of it. I like to call it the laddered approach
Sure.
to planning. But that hasn't really changed for us or for our clients, because even though the scenario of clients and their lifestyles may have changed a little bit, the need and the expenses hasn't changed.
Fair enough. So one of the things about life insurance or any sort of insurance is it's really used to mitigate risk. I guess with this around, life is more risky. You seen anything in terms of underwriting standards or premium changes that are because of what appears to be a now riskier existence?
Sure. So I guess the first thing we'll talk about is, as far as risk goes, carriers having new requirements. So now when you're putting in a policy or when you're getting ready to deliver a policy, and by deliver a policy, it means the underwriter has reviewed all the records and now they've given us a decision, the client accepts the decision. There are now new questions that are being asked, such as, have you tested positive for COVID? If you have, they want to see 30 days removed from when you tested positive and you're no longer seeking care. They're also asking questions of, have you been exposed to people with COVID or any scenarios? So if there's somebody in your house, they're going to want to see a 30 days, that you don't test positive. So they're doing things of that nature to kind of like protect themselves. Again, if you're submitting the application, they're going to hold off on it. If you're trying to get the policy, they're going to hold off on it if you've been in any of those scenarios. And in all honesty, I think it's a fair question and a fair response on their part. Again, they have to protect themselves. And there are things that could come up in the underwriting process. So it is a fair question. On the flip side of that, some carriers have put forward, increases in premium. But that is something that to do, they can't just do it on a whim. They have to go to the states. They have to show them, hey, we want to do an increase. Here's why. Here's what our numbers are looking like. Here's why it's a necessity. But we have seen a few flyers from carriers saying, oh, on this date, expect an increase of this percent and that percent. And I project there'll be some more, especially if the first wave starts to spread and if there's a second wave and numbers start to go up, they're probably going to have to do something.
I did forget to mention at the top of the program that if you do have a question, you can use the Q&A tab at the bottom of your screen. We will be taking questions now through the remainder of the program. So if you have a question for Ross, about something, we will be happy to try to answer it, whether it's insurance or deed-paying or something like that. I'm sure we'll do what we can. So again, use the Q&A tab and not chat, and we'll be able to get to that as you pop them in, should they be appropriate. So yeah, I think when we're dealing with all these questions about risk and all of that, we have this, I call it a short-term risk because we have no idea how long this risk will be with us, right? It seems emergent. It's right in front of our faces. Whereas some of the longer-term risks, long-term care, needing all of that are kind of things that people back of mind pass on. And those who are more attuned are thinking, hey, yeah, I've got to go get this. I know I need long-term care, but they don't know when the right time is to get it. What in your experience is the sweet spot in terms of trying to help people, navigate that market? And I've even seen from other people thinking about the long-term care market that medical advances will make long-term care in and of itself no longer necessary in 40 years. So when many of us, myself, I guess I need it in about 40 years if I needed it from a time perspective, how should someone navigate that? Because that you have so many different things at play with, obviously the long time until possibly needing it, the lack of certainty, as well as, the changes in technology and the like.
Well, the one thing that the market has really accounted for is there's a lot of carriers that were in the traditional long-term care only market that consolidated, pulled out of the market, and they were forced to come up with new ideas because they knew they needed to take care of their clientele. They didn't want to offer the long-term care. They were worried what it was doing to their finances, the risk that it was putting them in. So one of the things that, somebody who's saying to themselves, oh, in 40 years, all the advancements will be out there. I may not need long-term care. Why should I look at it? They do have riders on life insurance policies that you can access the life insurance proceeds early with no penalty if there is a long-term care event and you need it. Now, understanding that, okay, if you have, let's say, a $500,000 life insurance policy, and over the years you start to tap into it and you run it down and take, let's just for easy numbers, say $250,000 out of that policy. When you pass away, the carrier is going to say, okay, you had a $500,000 policy, you access the proceeds early, here's what's left, and that's what they're going to give the beneficiaries. So from a planning perspective, and again, it's what we do, and by we, I mean yourself, myself, when we're working with clients, we're kind of working on scenarios that, it's the if scenario, but we don't know for sure what's going to happen. So we kind of have to say, okay, what do we know we're going to need insurance-wise to, cash flow to keep the family going, to, and it could be if someone passes, a spouse is going to need liquidity, for the children, for the families, or whatnot. And then say we need to have the insurance, a separate policy, knowing that if something happens, this will take care of the long-term care portion. This policy over here, we need to stay secure and know that it's going to be there. So we don't want anything coming out of this one. So again, it's just part of planning.
Oh, sure, and it's part of planning, and I would think, from my kind of experience thinking about this thing, it's like, a lot of times I've seen that the time to think about the age, think about these things might be in that 50 to 65 range, just because you might be able to get the policy at the right area, and things don't change that much, right? So when I think about when thinking about aging circumstances, right? Like, we are still going through, for example, a change in Social Security that was started by Ronald Reagan in 1983, and that's not going to come to full fruition until 2027, right? Like, these are very long, gradual changes that have to happen. So at what point, so for me, sometimes I'm thinking the best thing is, if you're over age 50, expect Social Security the same for you. That's just kind of my mentality. It doesn't make me right. We saw a couple of changes recently that they were able to just put in. But in general, that's kind of where my head is at, because they have to signal these things. Does the same thing really exist in kind of, not necessarily life insurance markets per se, right? But maybe something like long-term care, because these trends take so long and the medicine and the medical takes so long, kind of be able to reprice that risk?
You cut out for a second, but I think one of the problems with why people are hesitant a little bit with the long-term care market and the traditional policies is there have been carriers who have come back to people and said, oh, to keep the policy going, we have to do an increase, and people are uncomfortable with that, and rightly so. It's like you buy something, you know what you can afford, you know what your cash flow is, and then for them to increase it at maybe an inopportune time for you, is frustrating. That's one of the benefits of doing the life insurance part with the rider, is that you don't see those increases happen. So, again, that is part of the problem with the planning. There is that fear in the background. Again, but as you're younger, as you're healthier, we all know we're healthy now, or what our health status is now. We don't know what it's going to be tomorrow. So, when you say, someone between 50 and 65, when should they start? Obviously, the younger and the sooner you start, the better it's going to be for you long-term.
So there's no too young in your mind, specifically having to deal with long-term care?
I think when it comes to dealing with long-term care, the younger somebody is, there are things that we look at first. Obviously, we look at what the life insurance need is. We look at what their disability insurance need is. And then, as you're younger, if we've checked off those two boxes, we may not be ready to start discussing long-term care at that point, especially if somebody's in their 40s or just entering their 50s. It may be a mention, but not a deeper conversation. I think usually when people get into start getting deeper into the 50s, maybe like mid 50s, like 55 is really when they start to think about it and plan for it. When I started in the industry 15 years ago, the average age of when a person was looking at these policies was in the mid 60s. And it's just gradually gotten younger and younger as time has gone on.
Fair enough. Yeah. So we talked a lot about long-term care, and one of the things, I guess, related to the pandemic that everybody knows about from a legal front is the CARES Act, right? That's the big stimulus package that gave businesses loans, that upped unemployment, but that kind of ended up overshadowing what was the Secure Act that got passed at the end of last year, related to IRAs and IRA distributions. One of the things I thought about was in terms of dealing with the issues from the Secure Act. And again, I don't know if you and I have discussed this outside of here, but what do you see as people using life insurance as a estate planning tool, and has that now changed? Because I think, at least under many circumstances, it's been more beneficial under the Secure Act to use that. And I think, I've seen other people in that business, in my business, say the same. So are you seeing people coming to you with saying, oh, well, I want to use more life insurance as a estate planning tool?
So, okay, I thought your question was going in a different direction at first, about use. I thought you were going to ask about utilizing the life insurance, the cash values, for people to do that instead of taking money out of their 401ks, which.
Well, we could talk about that too, but go ahead.
I think, again, when it comes to financial stuff like that and strategies, that's a conversation where, the client, yourself, myself would look at the big picture and see, what do they have going on? There's obviously my personal viewpoint where, is taking money out of your IRA, which would mean selling something in a crazy market and then later on not being able to recoup it, going to cost you more than you're expecting, or that, you're thinking about, versus if you had a cash value life insurance policy and you were able to tap into that, with no penalties or low penalties, and no tax consequences, that might be more to your benefit than going into an IRA or your other accounts, because you don't have to sell anything. You're not worried about capital gains taxes, and all the fun stuff that comes along with that. As far as using insurance as an estate planning tool, obviously it's a fluid situation. The laws change. Right now, today, they have certain numbers of estate taxes and death taxes and inheritance taxes, but that could change. And you have the federal number, you have the state number. So it's also going to be what state you're talking to somebody in and how they can utilize it. What are their assets? Are they leaving the family business to child number one, but child number 2 and 3 want nothing to do with it? So for things to be fair, somebody might take a life insurance policy out, for planning in that nature. So again, these are deeper conversations because every scenario is different and the uses for the insurance, again, vary.
Fair enough. So you were mentioning kind of people, well, you mentioned obviously people taking it out for cash flow in this time, and I could understand. And again, that's a planner question as to what's the best place to take money from. So thank you for that. Appreciate it. So we have a couple of questions from the audience, and I'll have one more question that I actually have that we didn't get to. So one asks, have carriers denied claims based on COVID?
Denied claims based on COVID? Yeah. Not that I'm aware of. Okay. Again, if somebody, let's say somebody put in a new policy, didn't disclose that they had tested positive, or didn't disclose that they had traveled to an area and then came down with COVID, and then passed away. Yeah, the carrier is going to deny that claim because somebody committed fraud. But if there's been a legitimate claim, somebody had insurance for 5 years, came down with COVID, carriers are going to pay those claims. They're not going to deny it. There's no reason to. Yet you have to remember, buying life insurance, disability insurance, long-term care insurance, it is a relationship that's built on trust. And if the carriers had a reputation for not paying legitimate claims, they would break that trust. People would question it. People wouldn't want to buy it. So, the carriers want to maintain that trust, because without the trust, people aren't going to want their product. So all legitimate claims get paid.
Sure. And so again, basically the reason you're saying something might not get paid is really because the customer was somehow misleading.
Correct.
Enough. Another question here, and if you have a question for us, please use the Q&A tab and we'll get to it. What's the oldest age someone can apply for long-term care? So if someone is too old to buy a new policy, and if someone is too old to buy a new policy, what are their options?
So as far as age restrictions goes, that's a tough question for me to answer, because we work with multiple carriers and they all have different thresholds. So, if one carrier does it, we basically open it up to all of our carriers, and I would say, okay, look, here's client A, here's their age, and see what carriers would say, yeah, we would take on this risk, or no, they wouldn't. If we're at an age where nobody's going to touch the risk, then obviously you can look at the life insurance policies, where they have some of the riders, and see if they'll let us attach the rider to it there, or if not, you get the life insurance policy to know you're going to be replacing any funds after the person has passed on. So again, strategy question, really depends on the assets and the scenario.
But isn't there a statutory limit, right? Like, best of my knowledge, like you wouldn't be able to buy a term after someone's 80. Isn't there some sort of statutory limit to being able to buy a long-term care policy?
I mean, dealing with most of the carriers, they're following their own rules, not their own rules. I mean, they're following state guidelines. So again, it's going to vary by state also. Offhand, I don't know, I haven't come across the scenario, thankfully, where I've had to deal with. So, knowing off the cuff, what that age is. But yes, like in New York, you can't buy term after a certain age, but in other states you can. In other states, your term can go out past it. So again, it varies by state.
Right, and of course, just because it can doesn't mean the carrier will write it.
You know what? Listen, if the person can qualify, show them an 85 or 90-year-old that's healthy, no issues, no medications, that can pass their criteria. Sure, they'll do it. Now, it's going to be expensive. And
Sure.
you may have to look at that feature. An old example, we were looking at something for a client last week, and basically, if the client lived 7 years, they would be on break even. So in other words, like if they would pass away anytime within the 7 years, then they spent less. After 7 years, they were spending more than the benefit their beneficiaries were going to get.
Sure.
Does it make sense? So you have to look at it. Does it really make sense?
Sure. Of course.
Again, what's the use of it? So again, everything is scenario based.
Fair enough. I guess the final question I have, I know we got off and we went into the long-term care conversation. As we continue to open, New York's supposed to hit phase 2 on Monday. The governor says yes today. The mayor says who knows what. But what do you expect to see in terms of customer behavior, client behavior, and maybe even insurance company behavior as we move into later phases of reopening and maybe even a second wave?
I think as far as carrier behavior, I think they're going to start to, request more medicals Things where they may have eased up on before, they're probably going to start to want, those medicals now they can get done. And things will get done a little bit faster. Hopefully doctors' offices will be more fully staffed so they can get medical records to the carriers. So those are some of the major, things that we see changing with as the city and the state starts to open up.
So this is again another question that just came in, and I'm not sure. I think we answered it, but let's be a little bit more clear. Are there new restrictions to getting a new policy during COVID?
The only new restriction are the questions. Have you been exposed to somebody with COVID? Have you been in an area where there's a high exposure of COVID? If that is the case, then there's a 30-day waiting period. If you have tested positive for COVID, again, there's a 30-day waiting period from when you are it's no longer in your system and no longer seeking care and treatment. Those are the only restrictions that have come up recently.
Very good. I realize for those of you who are here, I'm not even sure I said at the top that this is being recorded. It is on Facebook Live, and we will be able to get you a recording of this program, and I'll send you all an email on how to do that. So Ross, give me a second and tell people how to reach out.
Best way to reach out to me, there's actually two ways. You could email me at ross@3p-insurance.com, or you can call me 914-443-9709. And it's great to know that my phone number is now going to be live posted on Facebook. Thrilling.
Well, it's live on Facebook. It's going to be on YouTube. It's all there, but we got to take some risks
all right.
to develop what we're doing. I want to thank Ross Karp of 3P Insurance for joining us today on Discuss with Russ. You can reach me at Russell, RUSSELL .Rivera, RIVERA @voicewealth.com, or you call me at 646-630-0980. That's russell.rivera @voicewealth.com, or to call at 646-630-0980. We will be seeing a follow-up email link to the recording on www.voicewealth.com/blog, or you can view all of our videos on the Voice Wealth Management YouTube channel. This video takes usually about a week to get up and published. Next week on Wednesday, 24th at 2 p.m., we will have Warren Goldberg of Mortgage Wealth Advisors and Sean Anders of Douglas Elliman Real Estate revisit how the residential real estate market looks as New York City and the rest of the region begins to open, and look at how people are doing the city versus surrounding outside areas for living. So now that we're moving or starting to move beyond, people are maybe thinking about how they want to move forward. If you'd like to register for that webinar, you can again reach out to me at russell.rivera@voicewealth.com, or check your email inbox for registration email. So thank you again for joining us, and we will see you next time.
Thanks for having me, Russ. Greatly appreciated.
So long.